All right, guys, welcome to another video. We're going to dive into an example of how to analyze a property, and you can do this really quickly. So if you are intent on finding a property, you can do it quickly, throw the numbers together. That's what we're going to look at now. So for this first example, what I did is I went to realtor.com and I pulled up Lehi, Utah. Okay, just completely random, but I know that Lehi is growing a lot. There's a lot of technology. It's kind of the heart of Silicon Slopes, which is the tech startup industry in Utah. And so I said, hey, let's take a look there. Okay. So I found a nice looking neighborhood. I kind of narrowed in here, a nice little neighborhood, and I looked for homes for sale. I did the same for the same area in Lehi, and I just did homes for rent. So I found two comparable properties. One was for sale, approximately the same square footage. One had approximately the same bedrooms, bathrooms, right? All of those kind of details and in roughly the same area. And so I just compared them to understand. So I found this one house for sale. This one looks like a nice house on a pending sale right now for $549,900. It's got 3-bedroom, 2.5 bath, about 2,300 square feet. There's some HOA fees, price per square foot, all that, okay? But overall, it looks like pretty nice home. Looks like it's in good condition, so minimal updates needed. It's kind of in a little community there. Pretty new and up to date. Okay, so not a lot of upfront costs there as far as renovations go. Okay, so I found another similar property, like I said, that's for rent, and it is also around 2,300 square feet, 4 bedrooms, 4 bath in this case, so it's a little bit higher, but $24.95 per month in rent. And this one also looks pretty new on the inside. If you look, new finishings, it's modern, it looks clean, all of that, and they're roughly in the same neighborhood. So these are the two properties I'm going to compare against. So let's jump back over here and look at the numbers, okay? So property purchase price on that one we found was $549,900, okay? $549,900. Monthly rental income on that other property we found was $24.95, okay? Because it's a comparable property in the same neighborhood. And so we're gauging off of that, all right? Upfront costs. Now for this, the down payment, I decided to do 25%. So that down payment totals $137,475. Plus, if there's some closing costs, unless you restructure the mortgage a certain way, there might be some closing costs. Repair renovation, I'm thinking maybe $5,000 tops. Okay, maybe some fresh paint, maybe a new appliance here or there, something like that. Now we're going to factor in vacancies. So an occupancy rate of 85%, just to be really conservative, and say, hey, maybe 1 to 2 months of the year, I'm not going to have any rental income. Okay, so you got to factor that in. And then I'm going to set aside a reserve fund of 3 to 6 months worth of expenses. Maybe I can start smaller and build that up over time with cash flow. That's going to be about $14,500 I'm going to have sitting ready for kind of an emergency fund, right, for the property. All right, ongoing monthly costs. So my mortgage with that down payment, my mortgage on that property, and I'm factoring in a 4% interest rate because it's an investment property, is going to be $1,970. Homeowners insurance, $100. Property tax, $150. Property management, because I'm going to outsource management here, is $197 per month, right? 10% of the rental income, monthly rental income. Okay, I didn't factor in the HOA here, but I could have if that's an ongoing cost. Okay. Some of these costs you can pass on to the renter, right? Like HOA, utilities, you might pass on to the renter instead of covering them, obviously. Okay. So let's look at the total numbers. So total monthly rental income, $22,495. Okay. That's what the rent is going for. Total real estate expenses, $2,417. Net monthly cash flow, $78. Okay, so for a whopping $936 per year of positive cash flow, our total upfront costs, including repairs and the 25% down payment, is $142,475. So that's the money we put into the property, and we are cash flowing a solid $78 a month on that bad boy. So $936 a year, which leaves us with a 0.65% annual cash on cash return. Wow, that is something else. Okay. Again, I just went and looked in a neighborhood and I found 2 properties and average rents for a similar size property. I looked at a property I kind of liked and I just ran the numbers. Obviously, after running the numbers, I am not going to do that. That is not worth the effort in the least, right? 0.65% annual cash on cash return, which means the cash I put in, what's the return I get every year on that? 0.65% is not worth looking at anymore. Okay. So in about 5 minutes, I was able to cover that, look at all the numbers and see, hey, is this something worth looking into further or should I not bother? And obviously with this one, I shouldn't bother, okay? Now, a couple things that are interesting with this. Lehi, because it is a growing area, there's a lot of population coming in, new companies all the time. Like I said, it's kind of the heart of the startup atmosphere within Utah. Home values have risen dramatically over the last several years. They've just grown so much because the economy in Utah is doing really well. There's a lot of jobs. And so there is an influx of people into the state. It has lower costs of living than other places, strong economy, and great stuff. I like Utah. Outdoor living, national parks, all that type of stuff. So good things, good environment to raise a family, all that stuff. Okay, so I thought, hey, maybe this is a good area. Well, obviously, for rental real estate, this might not be a great area to invest in. So the people charging rent of $24.95, they may have purchased this a number of years ago, and so their mortgage is much lower. So they actually are cash flowing, right? They've raised rents, and now they're cash flowing a good amount of money, right? But if you go and purchase a property now and try and charge market rents, you might not be, we're barely breaking even on that. And if anything goes wrong, then we're in the negative. So we have to have a lot of upfront cash and then a lot of cash in reserves to cover that, okay? So that covers our first example. I'm gonna stop here. Next video, I'll cover another example looking at a different area, different property. All right, see you guys in the next one.
Next up, another real estate example. Don't miss it.